if you want to go and pay for your cup of coffee, at the coffee shop with a USDC in a mobile wallet or even through your Coinbase account, that needs to be like this fast, and it needs to cost basically less than a cent to transact. And it needs to be able to be done at massive scale. Only recently have we basically reached all three of those thresholds. This is the stupidest asset class in the world, still. And it won't be that way forever. Nobody really knows exactly what the path is going to be, even if I'd say many of us have high conviction in the ultimate destination. So if you want to be an investor in this space, your goal is really survive and advance. You don't want to be a value investor in this space because there really is no such thing. In that world where, you get both the power law distribution and this ability to scale incredibly quickly, this is just very ripe, grounds for momentum.
Hi, Leigh. Thank you very much for joining us today.
Thanks for having me. It's awesome to be here.
We wanted to have you on to discuss some of the research you're putting out and also some of the investment strategies that you're running at StarKiller Capital. StarKiller is a investment firm. You guys use quantitative approaches and data-driven approaches to build blockchain-based sort of digital asset strategies. And we're going to talk about two of those strategies today with you. One is a trend following strategy that you apply to, the liquid token universe. And then this other one, this market neutral DeFi yield strategy, which I think is going to be really interesting to talk about because that's kind of a little bit more maybe unique to you guys. So people that are listening here and like what Leigh is talking about can go to starkiller.capital to see his research and get on his distribution list. And I'm also happy to be welcoming back Kai Wu of Sparkline Capital. Our audience is getting familiar with Kai. He's not only been a guest multiple times, but now he's helping me out as a host from time to time. And so we wanted to pull Kai in for this discussion with Leigh. So thanks, Kai.
Thank you.
All right, Leigh, I wanted to start with you before we get into the strategies. Let's start sort of a little bit higher level. And you wrote a post on your site last year called Block Space Crypto's Heaviest Bag. And in it, I just want to read this quote. You said, "We believe there's almost a perfect corollary between the transition from Web 1.0 to Web 2.0 and what we are seeing take place right now in crypto." So I just want to get your take on sort of rounding that out a little bit and sort of where we are currently in the crypto evolution and how I guess it stacks up historically to that Web 1.0 to 2.0 transition.
Yeah, so if you think about what really precipitated the tech bubble and then the tech crash, it really was, we spent a ton of CapEx to put fiber in the ground so that people could access the internet and that internet protocols and businesses could actually produce an experience for people that wasn't, plodding and super slow. So we needed to basically build out all of that infrastructure. We needed to do material science and, all sorts of other, basic research in order to be able to provide that type of experience. And what basically happened in the first tech bubble and the crash was we finally got to the point where there was enough fiber in the ground. But by that time, all the businesses that had kind of tried to get built on the internet fell apart because they couldn't get enough users because the capacity wasn't quite there yet. Now, by 2003, 2004, when Facebook really started to get spun up, which to me is really the beginning of the next tech wave, we had enough fiber in the ground, it was fast enough, and that next wave of businesses was able to really thrive. So where are we kind of, as a corollary in crypto? We've spent basically, a decade now trying to build out the capacity, speed, and cost that is reasonable for actual crypto transactions to make sense at scale, right? If you want to go and pay for your cup of coffee, at the coffee shop with a USDC in a mobile wallet or even through your Coinbase account, that needs to be like this fast, and it needs to cost basically less than a cent to transact. And it needs to be able to be done at massive scale. Only recently have we basically reached all three of those thresholds for real applications to be built within the decentralized blockchain space. And so last year, yeah, we wrote that post basically saying, look, for the last, uh, decade, the whole crypto universe has basically been focused on what should we bet on in terms of the core protocols, the core blockchains, which one of them is going to be able to service those kind of three important things. And nobody really knew, right? Was it going to be, Ethereum mainnet, Solana, one of the million other, blockchains that is, specific to one little use case or another. And about a year ago, what happened was we sufficed all of those, all of those variables and crushed the value of a lot of these other blockchains, including Ethereum, because this thing that we had been betting on, which was block space being scarce, became not scarce anymore. And the valuation, underlying that whole thing fell apart for good reason. Our basic thesis now is that we are kind of on the other side of that tech bubble crash where, all of the fiber was laid and there was enough fiber and then nobody was using it. And so it all crashed. And now we're starting to see the rise of the applications that are built on all of that capacity. Instead of betting on the core protocols, this market is going to start betting on the actual applications.
And would like the Robinhood, like tokenization type of innovation be an example of like what you're kind of talking about, like the use case of it?
Yeah, I mean, it's everything. Like, I think the RWA use case is massive, bringing all of the different, TradFi assets onto blockchains in order to transact in a more efficient manner, globally, right, with a lot less friction. There are a million other use cases, for decentralized blockchains, most of which we probably don't even know yet. And I use another corollary in that post, which is, took having really good mobile phones, satellite, GPS, and some, innovative thinking to produce Uber, right? Uber wasn't produced right at the start of the internet, right? You needed time for people to figure out they could take these kind of pieces of these Legos and put them together. And I think we're kind of right at the beginning of that process now where you've got the capacity, speed, and cost solved, and the entrepreneurs are going to, kind of go wild now.
What are your thoughts? I know you've talked about in the past Bitcoin as, maybe not being the real, I mean, it's been a big winner, but maybe going forward being the long-term winner. Can you just kind of flesh that out a little bit?
Yeah. So one of the interesting aspects to this shift from betting on protocols, we call it the fat protocol thesis, where the theory was that protocols were going to accrue most of the value, to the fat app thesis, where the protocols are kind of quasi public goods, right? And there's an abundance of block space. That in that transition, what actually ended up happening was that Bitcoin, as the application of digital gold, ended up really outperforming on that basis, while all the other protocols, have massively underperformed over the last, 2-3 years. Our basic thesis, and this goes all the way back to when I did the original work on trend following and cross-sectional momentum in this asset class in early 2017, is that it would be ahistoric. It would be the first time that the first incarnation of any technology was the eventual economic winner in that space, right? Just put it as simply as Netscape and AOL versus Google and Facebook. And there's a million other examples of that, obviously, in every industry where that first incarnation of a technology is not the eventual big winner. And so we don't think necessarily that Bitcoin being an interesting but inefficient actual mechanism for the transmission of value. And I think anybody in crypto, no matter what, kind of tribe you come from in crypto, would admit the Bitcoin blockchain is not an efficient blockchain, but it serves a very specific application. And that application is really important. That application, digital gold, in order to get to the value of existing gold, right, about $12 trillion, we're talking about another 6 to 7x from here. And I think that that's absolutely going to happen. And it's likely that it goes beyond that. But I think when we look at, something like Ethereum, not the actual coin, but the network itself and all the value that will end up being produced on that network, it's much more likely that if you move commerce and, all manner of different assets on chain, that the value of that network ends up, exceeding Bitcoin by quite a lot. If you basically move, a lot of the world's commerce onto public blockchains.
So Leigh, you're making an interesting point that you think that the kind of total addressable market of, let's call it like, not the digital gold ecosystem, but the kind of computing layer or whatever is pretty interesting. Now, some skeptics have argued that that won't necessarily lead value to accrue to Ethereum, right? I mean, as we've seen, coincidence with this abundance thesis where we're now, seeing a decline in the cost of block space, the rise of L2s, et cetera. Ethereum has, until more recently, obviously been in a bit of a slump. So talk to me a bit more about, the kind of protocol versus app layer and kind of how you kind of anticipate, if this does come true, let's assume that this comes true, that, more activity moves on chain and on chain into, say, Ethereum and Ethereum-like, blockchains. How would you kind of envision the value accruing to applications, the underlying protocols, and other kind of participants within the kind of whole stack?
Yeah, I totally agree with that thesis. And that's largely what we wrote in that post, about a year ago. So our general view, and I say this with a large dose of humility, because try predicting, where the kind of digital asset ecosystem is going to go 2, 3, 4 years out. And at that kind of horizon, you're likely to look foolish. 6 months, a year, 2 years, I think we've got a pretty good beat on it. But, with that caveat, I think when we look at applications versus protocols now, we see that there are a handful of really, really important protocols, Ethereum being one of them, that may just end up being public goods. And that's great, right? Like, what does fiber cost? It's your internet is super cheap these days, right? It's very likely that is the same thing is going to happen here. So which applications and why will they accrue value? The idea here is that they're the only ones with an actual moat, right? In crypto, in digital assets, the switching costs are definitely lower than in any other kind of, financial space, but there's still moats. Owning users is still important. Trust is still incredibly important, maybe even more important in crypto than in TradFi, where the provenance of the code associated with a specific application is incredibly important to knowing that it's not going to get hacked, right? Aave's been around a decade, hasn't been hacked. Very likely is not going to get hacked. That's incredibly important when you think of the risk premia in this market, and yields you're getting on lending out your stable coins inside of those protocols. And so I really think that those are the only things with moats. I really don't think that L2s have moats. I don't even know if Ethereum has a moat outside of the fact that it will continue to accrue this trust as, bigger and bigger players and larger amounts of assets really live on Ethereum mainnet versus living on those L2s. It's likely that we may transact on the L2s, but that you will issue those assets on Ethereum mainnet because of that, ultimate trust.
Talk about this concept that you've written about, survive in advance, and how that kind of plays into how you guys go about your investing philosophy.
Yeah, so this goes back to early 2017 when I sat down to run those initial models. And the idea here is basically that this whole ecosystem, and it will be this way for quite some time still, is full of what are basically early stage venture bets. They just happen to be liquidly traded, somewhat liquidly traded, and to different extents. And in that world, you would assume that you're going to continue to see an aspect of a power law distribution of returns to these assets. Most of these companies are going to fail. Most of these protocols and applications are going to fail. And so if you want to invest in this asset class, you need to go in with the assumption that this is an early stage asset class, even if many of these things have billion or tens of billions or even $100 billion valuations. They can get usurped really easily and be worth, nothing eventually. So that's kind of the first principle. The second one is that, again, it would be ahistoric for an asset class to be growing this quickly without the associated incredibly high vol. It's not mathematically impossible, but it's pretty close. And so Bitcoin is still a 100 vol asset. And it's very likely that we're going to continue to see 60, 70, even 80% drawdowns a couple more times, both in Bitcoin and in the overall asset class, before we reach some kind of, not terminal, but, reasonably high adoption rate of both holding the assets and of using the actual technology. Today, globally, depending on which survey or who you ask, we're somewhere in the range of, 6 to 8% of people holding, an actual, decent amount of exposure in crypto assets. In terms of using the actual technology for some real utility, we're like sub 1% of the world. So we are still incredibly early in the ascension of that graph. And until we haven't even crossed the chasm yet, right? Like until we get to something like people owning, or something like 50 to 60% of people owning a reasonable amount of digital assets and some kind of like 20 to 30% actual adoption of real utility, we're going to continue to see massive, massive vol. So in that world, if you want to have exposure to the beta of the asset class over a long horizon, this is what trend following models are meant for, right? The idea of survive and advance is in a world where you continue to see these bubble and bust cycles, which are totally rational, right? Nobody knows exactly how big this is going to get. And it's totally rational that at any point in time, they revalue the thing an order of magnitude up and then revalue it an order of magnitude down. Because nobody really knows exactly what the path is going to be, even if I'd say many of us have high conviction in the ultimate destination. So if you want to be an investor in this space, your goal is really survive and advance. Basic math, right? If you're down 50%, you got to make 100% to come back. If you're down 90%, you got to make 1,000% to come back. But if you're only down 35%, you only need to make like low 40% to come back. So the real goal here is to limit the drawdowns in these bust cycles so that you can compound the growth at a higher floor each cycle. And trend following models just do a really great job at that. Even if you give up a little bit of the upside, and those trend following models usually get kind of whipped around at the turns, it keeps you out of those. It keeps those drawdowns, from really compounding to something that is really hard to come back from.
Well, and as you guys both know, because you both manage money for investors, that, dealing with a 50% or 70% drawdown, you're not going to have many investors left. So that's why I think for this asset class in particular, the trend following is sort of invaluable.
So just to, dig into that idea of trend following more, I think, for the audience here, I think you've talked about this before. There's two different types. When people say trend, there's really two things they're talking about: time series and cross-sectional. So just to kind of make sure that we're 100% clear, I believe you're talking about time series momentum in this case.
In this case, yeah. So the idea, and this is kind of the basic model, you can use time series or you can use moving averages or you can use all manner of different things like that to manage the beta exposure, how much beta exposure you have in a portfolio at any given time. And so we will go from fully beta exposed, and beta here being to Bitcoin. We'll go from fully beta exposed and even a beta of, more than one at times, to having zero beta exposure. And our primary our primary model, and we have, multiple, but the primary model is a moving average based model that has some interesting tweaks to it. But that tends to be the most simple and best, um, also easiest to execute model, both on a kind of purely on-off perspective and kind of coming in and out slowly over the course of, a number of weeks, for kind of the long horizon trend in digital assets.
And then talk to me a bit more about the cross-sectional momentum. I know you've written papers, and I know you published something with our friend Corey Hofstein as well, that I found pretty interesting. So maybe just start off by giving a kind of high level overview of like what was discussed in that research and kind of what you found.
Yeah. So back to the idea that this is a power law distribution of returns. A lot of these crypto protocols and apps will go to zero. But also they have the ability to really shoot the moon very quickly because adoption in this space happens at lightning speed, largely because you can move capital around between these things. And so these protocols, if they're engineered well, they do a little bit of good marketing. They've got some, reasonable backers behind them. And then they get a little bit of, kind of magic from some of the larger players who do really good research in the space, putting, liquidity into them. These things can go from having, $5-10 million in them as liquidity to having, billions of dollars in them in a matter of, weeks to months, if they're designed well. And this is a kind of a unique feature of the digital asset space, which is interesting. So in that world where, you get both the power law distribution and this ability to scale incredibly quickly, this is just very ripe, grounds for momentum. So the idea here is that there are roughly 400 tokens that are liquid enough for a fund that, let's just theoretically say, is running $100 million to be able to allocate capital into, with a portfolio. So let's say you want to allocate to 10 to 20 of those protocols. There are about 400 tokens. Now, obviously, you could not equally weight into those 400 tokens, but they're accessible. Of those 400, there's still a lot of garbage in there, right? That's just kind of the liquid universe. So the first thing that you want to do is, understand what's going up, because what goes up tends to continue to go up in crypto. And our specific incarnation of that very simplistic kind of concept of cross-sectional momentum, and it's changed a little bit over the last 3 or 4 years because we've seen some regime change in the market. But originally it was, 30-day time series momentum. Now it's more like 20 days. So we basically look back and we say, what's performed best over the last 20 days, stack rank that. And, you're really looking at the top quintile as having some significant alpha relative to the rest of the distribution. You definitely don't want to be in that bottom quintile, I can tell you that, because what goes down tends to continue to go down in crypto as well, which again makes a lot of sense because hacks, rugs, frauds, all of that kind of stuff. You don't want to be a value investor in this space because there really is no such thing. And so that's really the beginning of it. And then our specific incarnation builds on top of that with, a bunch of other variables that try and sort through that top quintile of things to get down to, what actually has fundamental momentum in terms of increase in liquidity within the protocol and, kind of all the fundamental growth going on, the number of transactions and number of wallets and things of that sort. But basic momentum tends to work really well. Now, I'll put a caveat on that, which I think is really interesting. And this is a piece of research that I'll preview here that we're going to publish probably about a month from now. But at the end of 2021, there was significant regime change in what was going on in that kind of cross-sectional momentum model. And the regime change took place because the behavior of the VCs, who are obviously the earliest investors in these protocols and are mostly locked up until kind of an unlock schedule, works its way through, historically, they would not sell any of their tokens in previous kind of cycles. And in 2022, they learned a very hard lesson that once your token's on lock, you should probably end up selling most of them, because most of those protocols are going to end up worthless. Again, power law distribution. Historically, they would just like hold them. They said they'll hold them for 10 years and then they'll just liquidate them after 10 years. But they learned that lesson. So in mid and late 2022, they started to change their behavior, where as these things unlock, they would just sell the tokens, no matter whether they had a 10 or 100 or 1,000x in the token, or whether, you know, they break even or down. Now, because of this, there was a lot more supply being given to the market. And anytime we started to see kind of serious momentum in the altcoin space in 2023, 2024, and even in 2025, you'd see VCs just really start, like, you know, putting supply onto the market and taking money off the table. Because of this, what we found is that cross-sectional momentum no longer actually works on a persistent basis relative to an equal or even market cap weighted basket of assets. So let's just take the top 50 largest, you know, market cap tokens that are not frauds, rugs, hacks, and, you know, things like that. Previous to 2022, cross-sectional momentum operating, you know, persistently with no decreases in beta exposure crushed that market cap weighted basket, even Bitcoin. Since 2022, it has gotten mauled, because every single time, you know, we start to really see that momentum in alts, the VCs sell into it. What we found, though, is that if you narrow down the time periods that you are applying cross-sectional momentum to simply time periods where we see large increases in breadth of performance of tokens in that top 50, the top 50, specifically an incarnation of more than 40% of that universe having a positive 30-day return, then cross-sectional momentum continues to work, and even better than it worked previously on a persistent basis. But you really need to narrow it down now to those time periods where we see significant breadth, because, and this is the economic hypothesis that we started out with, basically VCs see the momentum happen and they give it some time, right? Oh, okay, we're in alt season or whatever you want to call it. So we'll let the tokens run, and then after some period of time, we'll start to sell into it. And so the periods of time where the cross-sectional momentum works on an asset selection basis has really kind of gotten much more narrow.
Yeah, I mean, I think what you're describing is super interesting, right? Like, just stepping back, you know, go back to your historical analog to the dot-com boom. Any early stage technology faces power laws and these kind of winner-take-all dynamic. But, you know, unlike back in Web2, we have this unique, you know, feature of liquid tokens, where effectively you have liquidity close to day one, right? So you have this kind of weird hybrid of a venture-style power law with liquidity. And so there is the ability to trade around an asset that is, you know, a day from a token generation event, while you simultaneously have a significant amount of the float held by, you know, true venture funds who historically have faced long lockups, but that might be changing. And so it sounds like what you're saying is, you know, the unique feature of crypto relative to, you know, trying to, you know, navigate the dot-com boom, you know, 20 or so years ago, is having to model in the behavior of these venture funds who, you know, they raised a ton of money in 21, as we know, and, you know, obviously kind of suffered in 22, and, you know, their investors want their money back. How are they going to do that? And so they're effectively, you know, it sounds like they're almost like not trend, actually almost like the opposite, right? Where they're kind of taking profit as prices go up from where they were before. Maybe they were trend in 22 when they're, you know, trying to, you know, get out as the prices were falling so that they didn't get zeros. But now it's almost the opposite, which is, you know, super interesting that that's become such a kind of prevalent feature of the markets.
Yeah, so we've thought a lot about this. If you were spinning up a VC today in digital assets, would you play the classic kind of power law distribution game and hold for 10 years? Or would you more explicitly play this game where you are likely getting back at least, you're returning your money on probably 70-80% of your investments, but you kind of crush the two ends of the spectrum on either side to the middle so that you return capital sooner and your IRR goes up, right? Because you're returning your capital sooner. But you definitely cut off some of that right tail of your fund ending up being like a 100 or 1,000x fund, right? I think for most asset allocators, early stage asset allocators, it would behoove them to play this game and not the old classic game. Because as we all know, right, again, huge power law distribution to successful venture funds. So if I was investing in a venture fund today, my belief that I could choose a good one that eventually returned well would be higher playing this game than it would likely be playing, the previous game.
Right. I mean, I guess to the extent where you had the ability to invest in a portfolio of venture funds, you may want your individual GPs to continue to, have wide dispersion. You may not care about that. But to the extent you can only select one or a small number of funds to invest in, then coloring the distribution might make sense. So you don't get unlucky in some, roll of the dice where, crypto becomes a thing and you fail to make money, which I think is pretty much everyone's fear in the space these days.
Exactly.
Yeah, no, it's fascinating. Aside from like that, the breadth indicator, are there other like segments of the token universe that you found exhibit more or less momentum, like large caps versus small caps, certain sectors, right? Like if you think of like a industry classification type taxonomy, are there kind of conditionings that you do when you look at your universe to say, hey, this might be a more interesting area to run trend, while this might be more kind of a mean reverting subset of the universe?
Yeah. So this goes into kind of our hot ball of money thesis. And the idea here is that within crypto, things tend to kind of roll downhill and gather and then move from kind of sector to sector, if you want to put it that way. Basically, because there isn't a lot of intrinsic value to these assets, and I don't mean that in a pejorative sense. I mean it like most of these assets, while you could make the case that they are securities, and I do often, they're not actually imbued with direct ownership of the revenue or the cash flows of the business behind the token, which is a whole other can of worms. Is an issue for crypto right now that is getting solved with the new regulatory kind of regime and environment, which is great, but it's led to a lot of cynicism on the part of market participants. And in my opinion, that's really what led to the rise of meme coins, that hopefully we are kind of getting past that now, which would be great. But because these assets are relatively intrinsically valueless, you tend to get this like catch-up trade that happens in all of them, because there's very, very little, if any, rel-val trading going on here, right? We don't sit there and say, well, the FDV to revenue multiple of Maker is X, and the FDV to revenue multiple of, Athena is, X times 2. Thus, Maker should be revalued, in this run. It's just not how this asset class works. But what does happen is, let's say Athena, which is a stablecoin protocol, gains a lot of TVL and the token goes up a lot. What's going to happen is, because of the kind of very left curve nature of the crypto trading world, and again, this is precipitated by kind of a lot of the retail aspects to this market, they will just come after Maker right after it, because, it's another stablecoin protocol or another lending protocol or whatnot. And so they'll revalue all of them. And it doesn't really matter that, those businesses shouldn't be valued even close to the same. They'll just come after it. So one of the things that we pay close attention to is cross-sectional momentum within these sectors, because you really want to be focused on the sector that is happening. Now, you'll see that in that top quintile, right? When we look through the assets every week, as we rebalance, we'll see, wow, this week it's chock full of lending protocols, or this week it's chock full of game protocols. And it'll be pretty obvious like what the market is focused on. But at the same time, like, that obviousness is important, and you really want to focus on that, because after a lot of those VCs got destroyed investing in game protocols in 2020 and 2021, you haven't seen any momentum in those things forever, right? And so you might see one or two tokens kind of start to catch a bid, but the overall sector will weigh those things down because everybody's just super sour on game protocols. So yes, Kai, it is really important to also focus on the sector by sector cross-sectional momentum.
And so just so I'm clear here, I mean, you're between the kind of within sector and then across sector momentum. So in other words, is gaming as a theme catching a bid or not, right? Like post-Axie, whatever. Or is there an idiosyncratic token within gaming that, might be kind of taking off while everything else lags? So
And
for
we would-
your
and-
approach,
and we
which
would-
of those
and
two
we
things
would
do you value
bend-
higher?
Yeah,
Yeah.
and we would bend away from putting money into that idiosyncratic token within a sector that is not performing well, because it's very likely that that thing just gets sold and that momentum, gets taken out.
So you're saying that like the kind of like theme level or sector level momentum is actually pretty powerful and perhaps more powerful than idiosyncratic momentum in crypto at this point in the development of the asset class.
Again, especially for that sector that falls in the bottom quintile of sectors. Yeah, absolutely.
And so you actually mentioned one thing that was pretty interesting to me in the beginning of this section. You mentioned that the look back period over which you form a momentum signal has shrunk since you launched or since you started trading the asset class, right? Now, talk to me about why that could be. Is it just something that you guys have kind of figured out through your internal R&D, or is there a structural feature of the market that's changed over the past few years that has led to this?
Yeah, we think, obviously we pay close attention to the performance of those models, independent of our own book, obviously, kind of just the defaults. And, we really started to recognize this in like late 23. And, our hypothesis has a lot to do with those VCs. And it also has to do, somewhat with liquidity within the perps market. It has to do with how traders are handling new token offerings. It also has to do with the amount of different tokens that are kind of distributing the momentum itself, right? So, back in 17, like when I did the initial work, I think we had like 20 tokens to look at, right? And so for any given, and then, you go into the next cycle, the like 18, 19, 20 cycle, or 18, 19 cycle, and you start to get, some other stuff like Filecoin and, some other use cases. And so, but those use cases, it was just one token for each use case. And now, we go into DeFi summer and you start to get, 10, 20 tokens for kind of DeFi stuff. Okay, so now we've expanded to 10 or 20. You go into the most recent one, which I kind of look at as last fall, where the AI kind of token trade got spun up. And within a month, we had like 100 different tokens that represented this beta, right? This beta that everybody wanted to chase. And the full cycle on the like on-chain AI trade was basically 3 months, from like inception to full crash. So we're just speeding up. Like the market is just speeding up because you can spin up a new protocol, you can spin up a new token to like feed the demand for that beta exposure.
Right. I assume a similar dynamic at work when you compare the formation period for crypto to a traditional asset class like equities, where it's usually 12-month formation window. So basically, crypto is just kind of a faster paced, more frenetic asset class, and the hot ball of money spins.
Yeah. When people ask me, like, kind of normie friends in TradFi, that, well, what is it like to trade in crypto? I just say it's like any other asset class, just more so on every level. It's more on every level. Yeah.
All right. So I think for next, let's get into the nuts and bolts of your strategy. And I want to leave some time for the other topic we mentioned. But so just in terms of the actual strategy here, obviously there's like, as you mentioned, the ability to spin up an infinite number of crypto tokens. You can kind of just fork. So source code, it's super cheap to do that. I mean, I don't know how many on CoinMarketCap there are now. Millions of tokens are technically in existence, right? So how do you decide of those millions or so tokens that exist, what would be your investable universe? Like what's your S&P 500 equivalent of the crypto universe?
Yeah, so it's liquidly traded, which has a couple of different definitions regarding the total dollar value of assets that are traded on a daily basis. We look at DeFi liquidity. We look at depth of order book on the centralized exchanges. And we're only looking at exchanges that we can access. Because, you go into like CoinMarketCap or CoinGecko and you'll see, oh, this thing has, $100 million of, traded daily. No, it doesn't. Like, that's not the liquidity that you can actually access. And so, we have our own kind of, a variation of like, what is the actual liquidity? And then it's, what tokens can we actually access, right? Because we can only trade on certain exchanges because we only trust certain exchanges, for good reason, given the history of this asset class. And then also within DeFi, how much liquidity is there? And we can access anything in DeFi if it has enough liquidity. So that's really where we start in terms of the asset selection after we kind of get our target beta exposure from the trend following models. And then, from there, we run the cross-sectional momentum models and that kind of breadth screen in terms of, do we just want to be in Bitcoin, when Bitcoin is in a positive trend, or do we want to be in alts and how much in alts? And the breadth is, a large portion of that. And then we're looking at, within the cross-sectional momentum universe, what is happening within the sector level cross-sectional momentum. So really, what do we want to focus on? And now we've really narrowed it down to, probably from those 400, we've narrowed it down to something like 40 or 50 tokens. And then something between 15 and 20 at that point to, try and get a distributed enough, portfolio, but also within this space, like you really want your winners to count. And in terms of position sizing, that's obviously a lot having to do with liquidity, but also we pyramid up into positions. So in kind of classic trend following, kind of fashion, as you would do in commodity futures trading, we're pyramiding up into positions as they work. Again, because that momentum tends to, be sustainable.
Wait, so can you just explain to me the last step there? So you said your quant model, first you apply kind of a time series component, and then when the market looks interesting, you'll do a cross-sectional to get around 40 different tokens, which are, interesting. How do you get down from that to 15?
Yeah. So the first piece is literally just a very non-quantitative, okay, of these tokens, do we know any that are, really just bad businesses, founders, bad teams, dead protocols? I'll use a really good example right now. So Curve, right? One of the largest kind of DeFi 1.0 protocols, really good protocol from a safety perspective. It's good code. The team's done, right? It's dead protocol. It's completely dead protocol. That thing can only sustain so much momentum because there's no business being built anymore, right? The market will still use it for the underlying utility of what Curve is, but you're not going to see that thing shoot the moon because there's nothing being built. So we know these protocols pretty well, and we can weed through them, on that basis. And yeah.
So you'd almost say there's like a quality screen or a fundamental screen kind of at the last layer. Like price momentum is great, but like it could be trading on meme value. If there's no increase in the number of users, like developers, etc., maybe this is actually not something we want to be super bullish on.
There's two different concepts there. There's like what we call fraud, rug, hack, kind of dead team, that piece. And then there's like what's actually going on in the fundamentals of the protocol itself in terms of the adoption. And we pay attention to both. But that first set is just like a full, we're not touching it kind of thing. The second set is, okay, do we want to go bet on, the momentum in the fundamentals here or over there? That's more of a, we pick and choose from. But that first set is just, we're not touching it.
So I have just one more question on momentum before we move to the next topic, which is, now that, you must have been, you're one of the, earliest people applying kind of systematic trend into the crypto markets. And so, I'm just curious, like having been doing this now for several years, talk to me about like just the experience, like lived experience being in the markets trading trend over this period. Like anyone can run a back test, obviously. Just, kind of curious your personal, take.
Yeah. So as we know from, being quants, the hard part is not the research, and it's not doing the back tests, and it's not, going to production. The hard part is understanding the difference between a natural drawdown in the alpha of your model versus regime change, right? And so really, on a daily basis, that is maybe not a daily basis, but like, what keeps me up at night? Like, what do I worry about? Like, what's the existential thing that I worry about? It's not, do we have good models? It's not, the market crashing. It's not any of that. Is there some kind of regime change that I am not seeing, right? That we're not paying attention to? And that's why we have to be like, elbow deep in the actual ecosystem. You can't just kind of like sit, at some end of the world and not really know what's going on and run your models. Like, you have to understand fundamentally what's happening so that you can see the regime change. And that's really the hardest part. So the second, hardest thing is that in this asset class, and I kind of said it before, it's just like any other asset class, just more so. And that really applies to both returns and volatility, right? So you can't have the type of, total returns at the end of these cycles without the associated vol and drawdowns. And our model, it is designed to take a pretty serious amount of vol and serious drawdowns that I think in any other asset class, you would just say it's bananas. But, it makes total sense in this asset class. And so while, internally we know that, okay, the model is performing just as it should, perfect example is 2022, right? Where we took some significant drawdowns, but they were within the parameters that we were comfortable with, over a long horizon, as, per the trend following models. But explaining that to LPs, even all of your LPs that you've hopefully conditioned and accurately informed about the strategy and the parameters for the strategy, still, talking about those kind of drawdowns is not fun. And so, but that, to me, that's easier than the regime change stuff, because I think you can be really confident in that and having that conversation, because you've kind of trained your LPs ahead of time. But the regime change stuff is, you just don't know, right? Like, you don't know whether it's just natural drawdown or it's or you got to really do something with the models.
Now, let's switch gears, and I want to talk about the other strategy that you run. And I've heard some exciting news that you may be spinning out as a separate standalone, but originally my understanding is that this strategy was developed as a place to kind of park your cash while you were sitting out, the worst of the bear, based on your time series momentum strategy. So talk to me a little bit about what this does. My understanding is that you're looking to, earn yield in kind of a market neutral way, while you kind of maintain like a close to zero beta. But just the mechanics of this would be super fascinating. Again, like, for most of the listeners who are not like crypto natives, like, these are very unique strategies, different from, the kind of analogous credit and fixed income and, merger arb type strategies that exist in TradFi. So, I think it'd be really interesting to kind of double click on this piece too.
Yeah. I'll try and kind of span the spectrum of really simplistic and then, more sophisticated, interesting here. We have to do this for LPs as well. Every time, we kind of pitch this, regardless of how sophisticated the potential allocator is, you'd be really surprised. So the idea here is that those trend following models go to cash, sometimes for long periods of time, especially in these bust cycles. And, you need to make your cash productive. Now, normally in like a CTA model, you would be in treasuries, and that would be kind of the risk-free rate of return over which your model needed to exceed its expected return in order to go into beta exposure. Here, our risk-free rate of return is certainly not risk-free, but it's definitely not treasuries also. Whereas treasuries would be, 3-4%. Our risk-free rate of return, so to speak, is more like 8 to 9%. Why? So the idea here is that there is yield to be captured within the crypto ecosystem. So where does yield come from? It comes from a couple different places. The first one is it comes from lending protocols. So these lending protocols are very similar to just like a margin loan that you would take from a brokerage account. You put up assets as collateral, you take out cash. It's just, in this case, there's no brokerage sitting between you and the loan. You're literally the money that is behind the margin loan. Take stable coins like USDC, which is the safest stable coin out there, and we can stake it into a lending protocol like Aave or Morpho, and we will get a yield based on the desire for people to borrow those stable coins with other assets. Now, different lending protocols have different assets that you can provide in order to, as collateral. So let's just say ETH and Bitcoin. And the nice part about these lending protocols is they're all over collateralized lending protocols, meaning that you have to always be fully collateralized in terms of your loan. And if that collateralization ratio drops below 100%, you get immediately liquidated, meaning that our capital is basically never at risk from any kind of under collateralization. Now, there are other risks to these. Obviously, the risk premia in this space is basically hacking. A lot of protocols have gotten hacked over the years. Although Aave, which is now, I think, the 26th largest bank in the United States by deposits, if you want to analyze it that way, has been around 10 years and never been hacked. So some of these are starting to attain a longevity of their code that gets us really, really comfortable with it being pretty close to risk-free. If you're depositing the right stable coins like USDC. So that's one area of yield. Other areas of yield would be supplying liquidity to bridges. So people moving across one blockchain to another. Those have historically been pretty brittle. So we don't do a lot of those. Those get hacked quite a bit. Other ones are supplying assets to a decentralized exchange. So it could be one stablecoin to another stablecoin. People want to swap stablecoins, and you're basically supplying the liquidity for to be in that pool for them to swap it, and you get a little percentage of the trading fees that go across that pool. And then there's a couple others, one of which I think is the really interesting piece to this, and it really goes to the heart of why is crypto interesting at all to begin with from a capital formation perspective. And that is what we call basically rewards farming. And then there's this concept of early liquidity provisioning. So what is rewards farming? The idea here is that if you spun up Uber today, it would be very different from if you spun it up, 10 years ago or whenever it was created. So Uber had to raise tens of billions of dollars in venture capital to subsidize both the riders and drivers of their network in order to get to some escape velocity, right? Where they owned this market that everybody wanted to use their protocol. And eventually they could then raise prices, right? In order to pay the drivers like a real wage without having to subsidize it with all that VC cash. Today, you wouldn't do it that way. Today, you would do it the crypto way, where you would spin up that network, same as you spun up Uber. But what you would do is you would say, okay, in return for riding and driving, we're going to give you rewards in the form of our equity, in the form of our token for doing that along the way for some amount of time or until some threshold was passed where the business felt that it had escape velocity. And then we would shut those rewards off, or we would kind of really stem the flow. This is what happens in almost every crypto protocol and application these days. And so what we do is we take our liquidity in the form of those stable coins, and we will provide it to the new protocols that are launching after we do a lot of diligence on a lot of different levels. And we will chase those early rewards for providing that liquidity. So in the case of, let's just say, the Felix protocol on Hyper EVM right now, so Hyperliquid's blockchain, Felix is kind of the major lending protocol that got spun up. The native yield that we're getting from supplying USDC to the protocol is something like 7-8%. But our expectation is that we're also likely earning another 8, 9, maybe even 10% in what will eventually be the rewards from their native token by supplying that liquidity. Hop around between these things based on our diligence. and based on where the rewards are greatest, to capture those. And then the last one is sometimes, protocols will do early liquidity provisioning deals with firms like ours, where they'll just be about to launch and they don't want to launch kind of naked or, just with nothing. And so they'll go to firms like ours and they'll say, if you lock your liquidity up for, let's say, 6 months or a year, we will not only give you the native yield of the protocol like everybody else, but we'll also give you a guaranteed floor of yield for those extra rewards governance tokens in their equity. And they'll strike that deal at some FDV. So when their actual equity token, their governance token launches, let's say in 6 months or a year, they'll say, if the value of that token is, a total of, let's say, $100 million, your extra yield will be another, 15% or 10%. But everything above that, you participate in. So if we come out at $200 million, your reward is going to end up being 20% or 25% or whatever it is. And so we end up turning into, for that strategy, kind of like a quasi VC that takes no beta exposure. So we get the native yield. We obviously have to do the diligence to make sure that protocol doesn't get hacked or fall apart or rugged or whatever. But then we're betting that that protocol is going to be really successful and that our governance tokens will eventually be valuable, and then we'll sell them.
Got it. So it sounds like a mix of different strategies, like kind of what a traditional bank might do, but within DeFi, within the AMMs, you're doing the kind of liquidity provision, and then kind of a venture capitalist like activity. You're also helping to bootstrap network effects and kind of the next Web3 Uber or whatever.
Kai, that's exactly the term that we use, in a lot of our marketing, which is bootstrapping network effects, which I think is one of the more interesting aspects of this market. And I could talk about some really interesting ones that are going on right now, kind of within the perp deck space. So kind of talking about Hyperliquid. Hyperliquid has kind of shot the moon here. It's 25-30% of the perp volume of Binance now. But there's some other really interesting incarnations of perp dexes that are getting spun up right now, like variational and lighter. Some things that our advisor Corey Hofstein is deeply involved in for a lot of different reasons. But one of the things that these applications have that's interesting is, and I think a lot of your listeners will find this just super interesting. So the perp dexes have internal market making vaults where they have their own high frequency market maker that is operating on their own perp dex exchange, perp dex. And sometimes they open up these vaults to outside capital so that you can actually be the money behind an HFT strategy. So in the case of Hyperliquid, for the first year, that vault was working on at like a 6 sharp with like 150% return. Now, as the protocol gets bigger and there's more liquidity in those vaults, that APR, comes down quite a bit. Now there's like $400 million behind the internal HLP vault for Hyperliquid. And the APR is something more like 14%, which is still an amazing return. But these newer vaults, which we go into, we diligence the protocols, then we go into, these things operate, at something between 50 and 100% APRs for 3 months, 6 months, 9 months. And some of them will even do early liquidity provisioning deals with you. So as there's more and more liquidity in the DeFi space, I think you're going to see more and more protocols really get spun up that require more and more liquidity. And there's going to be really amazing opportunities if you do the diligence. And there's going to be a lot of rugs and hacks and frauds as well. But these kind of market making vaults are super interesting to us.
Wow, yeah, that's interesting. So just a step back. So it sounds like basically what you're saying is you're, underwriting various risks like hacks and fraud and rug pulls. But that's no different than what a traditional bank or any sort of, even a venture fund would do. Obviously, there's been a lot of especially in 22, right, when we had a lot of the CFI lenders go down, right, without mentioning any names, that was obviously a black stain on the industry. And so, like, I guess the question is, like, how is what you're doing different? And I think I know the answer, but I'd love to hear you say how what you're doing is different. Like, should there be, or why is there risk premium available here that's in excess of what one might be able to obtain in TradFi? And how do you see that evolving over time as more capital starts, doing these sorts of strategies?
Yeah, so our counterparty risk is really different from what one of those CFI exchanges or prime brokers, would be, that really got damaged in 2022. Our counterparty risk is really counterparty to the code. And so a lot of our diligence centers on reading the actual code, reading the audits of the code, understanding who these founders are. What is the provenance of the code? Many of these protocols are just forks or derivatives of Aave or Morpho or, or a DEX or Uniswap or, and so understanding what the provenance is and then understanding what their specific flavor of, what they're trying to achieve that's interesting is, what have they built on top of it? That's really the piece that you need to diligence the most, because that's, the unique code. So reading the audits, we even throw both the audits and the code through ChatGPT now because, man, I can't tell you, like, it's found errors that we've, really bent away from. And then we pay very close attention. Who are these founders? Where do they come from? We don't put liquidity in anything with an anonymous founder. That has been statistically a bad decision historically within crypto. And then on top of that, when you think about, who the VCs are behind it, we've seen some hacks of some big protocols just get fully filled by the VCs behind the firm, right? So Wormhole, right? A big bridge. Again, bridges are brittle. The Wormhole hack got basically fully filled by Jump. And so, like, understanding who's underwriting this thing, who's the ultimate underwriter of this thing? Is there any margin of safety there if it does get hacked? That's obviously really important. So yeah, those are kind of the big variables that we look. And then, obviously we look at how much liquidity is in the protocol and our kind of position sizing and risk management processes. We actually quantitatively rank every single protocol on 8 different of these variables. Each of them has a different weighting in the eventual model, but then we build a risk-adjusted expected yield score. So we kind of expect a certain yield based on different dynamics. And then we position size based on that risk-adjusted yield. And that's served us pretty well because you won't find us putting 20% of our capital into like 100% APR vault for, founders that we don't trust and, whatever. But you might find us putting 2% of our capital into that vault because the risk-adjusted yield would be pretty good.
This has been a really interesting, fascinating discussion with you, Leigh. We have one closing question, but before I get to that, I just wanted to ask you, Kai mentioned this earlier, you've been doing this for a few years and sort of one of the first people that I knew about, actively investing in blockchain, these digital assets, but has it gotten more competitive? Is the edge harder, or is it still just a fertile ground for having an edge? Because your due diligence process, it's like you got to look at a number of things, just like you would, if you're a fundamentally based equity investor. But it seems like there's less competition here. There's more of an edge. But I'm just wondering, has it gotten more competitive, or is it still like really fertile ground, would you say?
Yeah, I have this conversation with some of my who I'm sure many of them are friends with Kai as well in the kind of equity quant market neutral space. And, they just say, man, it is a knife fight over here for basis points. And it is. This space hasn't necessarily gotten more competitive. It's just that some of the alphas have disappeared because of the regime and the way that the market is structured, not necessarily the competition within the market. It's other dynamics. I will say that, and this is not something everybody agrees with. It's, one of my kind of hot takes, which is that I think momentum, honestly, is like the only real alpha, like the only real persistent alpha that'll be around forever and has been around forever, because it is a behavioral aspect of humans that you will never erase. Value, to me, is not alpha. It's something different. It's basically just processing power. I know a lot of people disagree with that, but kind of what's happened in the last decade kind of backs it up. So I think momentum will be around forever in this space. It will wane, obviously. Certainly we're at like the peak of it here over, some kind of, last 5 years, next 5 years, kind of thing. But that aspect I don't think is going away. In the stable, in the yield space, that is definitely getting more competitive for sure. And there's two kind of competing pressures. One is you're going to have a tremendous amount of liquidity come on chain because of the recently passed stablecoin bill. Freaking JP Morgan is spinning up a stablecoin, right? Like they're going to push hundreds of millions, billions of dollars on chain, and all that money is going to want to go somewhere and be productive. And so the amount of liquidity that is going to be available to people who want leverage is going to go up. And so the leverage is going to get cheaper. That is just absolutely going to happen. On the other side, because of all that liquidity coming on chain, I think we're about to have just like the second Cambrian explosion of DeFi protocols, because the regulatory environment has just gotten a lot better. These things are getting safer, and there's just going to be a tremendous amount of liquidity. So those protocols are going to get spun up, and we're going to be able to go chase the rewards of those protocols and pick and choose from the right ones. And so I think that's the kind of countervailing, pressure against the massive amount of liquidity that is coming. I will believe that on the like quant side for the liquid stuff, that it gets a lot more competitive when we see the major variables associated with the relative performance of tokens stop being really stupid in nature and start being more deeply fundamentally oriented, like rel-val type trading. And we are nowhere near that right now. Like we like to say, like, this is the stupidest asset class in the world, still. And it won't be that way forever, but it absolutely is right now. It'll be that way for some time.
So closing question here, kind of a hard pivot, but we got to end it at some point, which has been great though. But so based on your experience in the market, what's the one lesson you would teach your average investor?
The average investor, do not attempt to actively play in this market, because the vol will just absolutely eat you alive. If you want to be in this market, you got, basically you got two options. Either just DCA into like Bitcoin, basically, or give your money to somebody that manages risk. But like once you start trying to time this stuff, it just, don't do it.
Good stuff. Thank you very much, Leigh. We appreciate it.
Thank you for having me.
Thanks, Leigh.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.